What's going on, guys? This is Lior and welcome back to my channel. Now, what I thought I would do in this video is go over my high-level underwriting structure for multifamily, right? So get a lot of questions, especially from newer investors or LPs sometimes, right? People looking to just invest passively. And they ask, like, what do I need to look for in a multifamily? How do I actually approach underwriting a multifamily? So what I thought I would do is kind of give you my process and breakdown, as well as the things I'd look for when actually underwriting. So with that, let's get at it. What's going on, everyone? My name is Lior and welcome back to my channel. Now, before we get into the meat and potatoes of the video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I'm putting out weekly content on this channel talking about everything multifamily, from constructions, operations, underwriting, raising capital, scaling out, everything in between. These are my thoughts, everything I know about the industry. So make sure you subscribe to the channel. And with that, let's jump right into it. So as I said, we're gonna be breaking down my underwriting process for multifamily. So let's first start with the most kind of the basics of any business, right? A basic P&L, right? And with a P&L in real estate and multifamily, essentially what you're gonna be looking to do is getting the rent roll, right? And then your operating expenses, right? Which is typically seen through a T12 statement, right? Trailing 12 financials of the property. So let's kind of break that down in a little bit more detail and start with the rent roll. And with the rent roll, there's not too much to it, right? In terms of at a high level, right? There's not that much complexity. At the end of the day, it's what the unit mix is, what kind of units you have, and what kind of rents you're charging per unit, right? So it's really a chance for you to analyze what's kind of going on, right? What kind of rents is the property generating right now? Or do they seem in line with market? Do they seem way out of line, too high, too low? That's what you're trying to do when at first looking at the rent roll. I want to see how it relates to what I think the market should be. And then the other thing I want to look for with rent roll is trends, right? So, you know, if there's a bunch of new leases that were just signed and the rents seem kind of high, right? Is the seller potentially ponying up the property a little bit, trying to make it look a little bit more attractive on the front end, you know, for a potential buyer? Is he doing that because he's trying to hide some things, right? I'm actually, you know, just to give you an example, I'm evaluating a deal right now where the seller's telling me he's bumping up rents by 10 to 15% on, you know, as he's prepping it up for sale. And it's kind of making me think, well, you're already getting top dollar rents and you're bumping it up another 10%. You're clearly just ponying this thing up. I don't know if these rents are really sustainable, right? So, you know, the point is you really want to try to figure out what are the trends, right? Are the rents going up? Have there been substantial rent increases? Have there been substantial new leases in place? And you want to try to get a feel of what's going on with the property. Now, on the expense side, right, when you're looking at the OpEx side, you're gonna look through the trailing 12 financials, right, to really get a feel. Now, here's what I like to do. You know, I've obviously been underwriting a lot of deals, so I have a sense in my market of what kind of average OpEx I would expect a certain property to have, right? Like, for example, I know, you know, I have a general ballpark idea of what, you know, water and sewer should be per unit, or what repairs should be per unit, or, you know, common electrical, or any other common utilities, right? You know, I just got a standard sense of where a property should be penciling out depending on its size and number of units, right? So when you get the financials at first, right, and you look through those numbers, I actually like to compare the seller's numbers and then what I would predict the average would be between, you know, for that kind of property and that kind of unit count. And what I'll do is kind of compare the two side by side. And actually, typically, if the seller's numbers are lower than my averages, I will actually use my averages, right? Because you know, sometimes sellers may be hiding some things or trying to finagle the numbers. So I know what my averages are, so I will typically rely on them unless the seller's numbers are higher. Now, the next thing you kind of want to be looking out for on the expense side too, similar with the rent side, is trends, right? Are there any major trends with expenses? Is OpEx or repairs super high, super low? Is it trending up, trending down? say, anything else that could potentially signify something that's going on the property, right? Maybe was there like a super high water bill, and the seller told you they had some big plumbing issues that they fixed, right? You kind of want to see, are there any major trends? Is there anything that's standing out or popping out, that can help you evaluate what's going on in the property? Now, few notes of things that I see, quite a bit on the underwriting that I think are really good tidbits. Number one, this is particularly valid if you're looking maybe at smaller to mid-sized multis. I see a lot of pro formas without property management. If you're an investor, you're probably sticking property management there, right? So make sure you have a property management line item. If you're looking at bigger stuff too, I'm not gonna get into it, but things like payroll and stuff like that, you're gonna wanna make sure it makes sense. And then number two, the other thing I see a lot happening is repairs and CapEx line items. And sometimes what I've seen is sellers will kind of offload repairs into CapEx, right? Because not to get too technical, but CapEx technically is below the NOI, right? So to increase their net operating income, they will take some basic repairs and put them into capital expenditures. So, if you see the CapEx line items being really, really heavy for the last year or so, you may wanna get more detail and see what was actually improved. Are those true CapEx items, or are those just basic improvements, right? And again, kind of sort out your numbers based on what you believe to be the reality. Now that we kind of saw the trailing financials and what's currently in place with the financials, the next logical thing to do is look about future projections, right? And what you need to look for in future projections will depend a lot on what your business strategy is, right? If you're underwriting value add, right, which a lot of us are looking at value add deals because that's where we can make margin, we want to figure out, okay, well, these are our in-place rents right now. So first, what are the potential upside rents, right? So you're probably going to want to do an analysis to see what you can bump rents up to, right? And this can be based on your market knowledge, market comps. You can see what are renovated units going for, right? Now, once you actually know what you're pushing towards, the next question becomes, all right, well, what do we do to get there, right? And this is kind of where you're gonna start to get a little bit of a high level feasibility of the type of construction you're gonna be doing, right? Is the property just gonna need really light cosmetics, right? Like maybe super in, quick and out. Is it gonna need a heavier lift, right? Heavier lifts in the kitchens, baths. You're gonna be doing flooring, painting, any mechanical work, right? So again, obviously when you're first underwriting deals, you haven't walked the property, so it's not like you can fine tune an exact number, but roughly I can get a pretty good sense of where my construction budget may lie, just depending on a high level, right? If I know I'm doing kitchen bath turnovers and I'm in Boston, I'm probably spending about 15,000 bucks a unit. Boom, I can kind of underwrite that as a rough rule of thumb, right? Again, I'm obviously gonna get a lot more in depth and more detail as I do my due diligence and walk the property. But just to kind of start getting a sense of how these financials are gonna stack out, that's what I'm gonna do, is try to figure out what my construction is, what my business plan is gonna be, so I have a sense of what the underlying financials may look like. Now, one other note I'll say about this part too, you can also do this on the operational expenses side, right? So, if you look at the expenses and something's just sticking out, that maybe the seller's incurring really high expense costs, and you think you can beat down the expenses, that's another item where I would look through and see if you can beat. I don't really like to do this too heavily, right? Because it's hard to have your business plan be solely based on decreasing expenses, right? Maybe the seller's doing something weird and not being super efficient on one line item or two, but to have your business plan centered around the fact that you're gonna be a better operator and you're gonna cut expenses, typically it's just not a good idea, right? I mean, most of the meat typically on value add plans are met by increasing income rather than decreasing expenses. Again, you might find a line item or two where maybe you can do a little bit better, but just be a little careful if your strategy and all your kind of returns are heavily based on just cutting expenses, because that's, I think, a kind of a hard business plan to really implement. And finally, the last kind of bulk of items I look at is, what do my exit projections look like on the deal, right? And with exit projections, I'm typically looking at two main things. I'm looking at what are interest rates and what are cap rates during my exit, right? And with interest rates, it's probably going to be more important if you have a refinance as part of your exit plan, right? Because if you're going to be doing a cash out refinance to return some capital, then you're going to have a lot of sensitivity around that interest rate on the back end, right? Because if you have a point increase on your interest rate, that's going to significantly restrict the amount of capital you can pull out. Same thing if you have a point decrease in the interest rate, it's going to allow you to pull out much more cash. So that's going to have a lot of sensitivity. And then of course the exit cap rate, right? I mean, I usually underwrite at least 50 to 100 basis points higher on the cap rate on my exit than it is today, right? Because, I think in 5-6 years, whatever my timeline is, I want to be prepared for the scenario where the cap rates have decompressed a little bit, right? Because that's kind of my worst case scenario. So that's how I run my numbers, right? Is I add that extra 50 to 100 basis points and I look, how does the deal pencil out? What does the property's value pencil out at that time? And can I still pencil the numbers out, right? And if I can't, that's fantastic. If my underwriting is starting to break when I'm putting in those kinds of stress tests, that might be something I would really consider, right? Unless you're buying in some sort of prime location, right? Maybe you're in like downtown LA or downtown New York or downtown Boston, or maybe you don't think there's any cap rate decompression gonna happen, that's fine. But again, for the majority of us, you wanna have that sensitivity to make sure that if the market does weaken when you're exiting in whatever, 5, 6, 7 years, your property can support that. So that's at a high level how I look at underwriting. Again, it starts with the trailing and current financials, the rent roll, the T12 on the OpEx side. Then I look at what I can do in the future, right? With my business plan, with my construction, with my bumping of rents. And then I look at the exit projections, right? Making sure my exit's tight and that, I've done some sensitivity around the different, around the different cap rates and interest rates to make sure I can still smoothly exit out of the deal. So hopefully that's helpful, guys. Of course, if you have any sort of questions, hit me up and I will definitely help you out.